Hello and welcome. Today, investors across the country watched as the U.S. stock market took a sharp downturn, with major indices posting significant losses by the closing bell. In this detailed update, we'll examine the factors that led to the sell-off, from concerns about slowing economic growth to ongoing trade disputes, corporate earnings warnings, and signals from the Federal Reserve. By the end of this breakdown, you'll have a clearer understanding of why the market is reacting the way it is, and what it could mean going forward. Let's dive in. As trading opened, stocks were already under pressure. Over the course of the day, those losses began to accelerate, with the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite each experiencing steep declines. Investors and analysts attribute the volatility to a confluence of factors rather than any single event. In times like these, it's crucial to recognize the bigger picture. When multiple warning signs begin flashing simultaneously, market sentiment can turn negative very quickly. One major concern fueling this downturn is the mounting evidence of a slowdown in economic activity. Recent reports show that consumer spending, which is a key driver of the U.S. economy, dipped for the first time in nearly 2 years. Meanwhile, purchasing managers' indices tied to manufacturing and services have also shown signs of weakness, indicating that business expansion may be stalling. When the engine of consumer demand falters, the ripple effects are felt in every corner of the market, from retail giants to small businesses and suppliers. Economists caution that while a single month of tepid data is not necessarily a cause for alarm, multiple consecutive reports that fall below forecasts can create a domino effect. Companies anticipating reduced demand may slow hiring, cut back on inventory orders, and reduce capital expenditures. Households feeling the pinch could limit their discretionary spending, depriving the economy of the robust consumption it needs to maintain growth. All these behaviors feed into each other, creating an environment where caution overshadows optimism and drives market volatility higher. Next on the list of investor anxiety is the Federal Reserve's stance on interest rates. Although inflation has come down from its peak, recent data suggests it's still more persistent than many had hoped. Fed officials have signaled that they remain committed to containing inflation, which may involve keeping rates higher for longer. For stock markets, the implications of a hawkish Fed can be twofold. First, higher borrowing costs for businesses can deter expansion projects and weigh on corporate earnings. Second, higher interest rates often make safer investments, like bonds, relatively more attractive, prompting some investors to move money out of stocks. The resulting mix is a delicate balance. At the same time that concerns are growing about a slowdown, monetary policy remains restrictive. This interplay between growth fears and inflation containment efforts has heightened the sense of uncertainty roiling the market. Another critical piece of today's market puzzle is the renewed threat of trade conflicts. The announcement of fresh tariffs, coupled with indications that major trading partners might retaliate, raised the specter of higher costs for businesses and consumers. Tariffs can act like a sudden tax on imported materials, which means companies could face the dilemma of passing these extra costs on to customers or absorbing them and reducing their profit margins. Over the short term, the prospect of a full-blown trade war injects fresh volatility into financial markets. Looking farther ahead, prolonged trade tensions could significantly hamper global economic growth. Investors become nervous, and businesses, uncertain about the cost structures and the reliability of supply chains, tend to slow investment. These developments have a way of reinforcing each other, pushing risk-averse traders into a defensive stance and driving riskier assets down. A slew of negative or cautious corporate outlooks only added to today's jitters. Several big-name companies have come forward with profit warnings or tempered their earnings guidance for the remainder of the year. Retailers, in particular, have expressed concerns about the combination of waning consumer spending and potential tariff-driven price increases on everyday goods. Technology companies, which often rely on global supply chains and sell products heavily exposed to consumer sentiment, also voiced similar apprehensions. Earnings warnings can weigh heavily on market sentiment. Stocks are priced not just on what a company has done, but on how it's likely to perform in the future. When forward guidance disappoints, investors may lose confidence, and that can translate into broad sell-offs, especially among growth-oriented and trade-sensitive sectors. As you might expect in a risk-off environment, there was an observable flight to safety today. Defensive sectors, including utilities, consumer staples, and healthcare, fared better than growth or cyclical sectors. Investors often rotate into these areas when they expect volatility or economic turbulence, as defensive companies tend to have steadier demand for their products and more predictable earnings. Beyond equities, the price of gold edged higher, and yields on U.S. Treasury bonds ticked lower. These moves typically point to heightened concerns about market or economic risks. In other words, rather than chasing higher returns in stocks, many investors decided to park their money in assets perceived as safer, reflecting an overall shift in sentiment. The big question on everyone's mind is whether this market pullback is a short-term dip or the start of a more pronounced downturn. Much will depend on the interplay of factors we've discussed: how quickly inflation cools, if and when the Fed adjusts its policy approach, and whether trade tensions escalate or subside. Fresh economic data in the coming weeks, particularly around employment, consumer spending, and manufacturing, will either confirm or challenge the view that the economy is slowing. Many analysts believe volatility may remain high until there's more clarity on these issues. A resolution in trade negotiations, for instance, could quickly calm markets, while an unexpected drop in inflation might pave the way for the Fed to revisit its rate outlook. On the other hand, if trade talks break down further or key data reports continue to show weakness, additional market swings are a real possibility. In times like these, it's easy to feel overwhelmed by headlines about market crashes and economic headwinds. History shows that markets often move in cycles, and short-term volatility can sometimes offer opportunities for long-term investors. Still, caution is warranted. Policymakers, businesses, and consumers all have a hand in shaping the economic trajectory, and their decisions, over the next few weeks and months, will likely influence whether we see a rebound or deeper declines. We hope this in-depth look at today's sell-off helps you understand the complex forces at play. Thank you for joining us for this update. Remember that while the current market environment may seem unsettling, staying informed and keeping a balanced perspective can help guide better decision-making. Until next time, stay vigilant, stay informed, and take care. This discussion is provided for informational purposes only and does not constitute financial advice. Investment decisions should be based on your own analysis and, when necessary, in consultation with a qualified professional.